Let's talk to Clem Chambers. He's the founder of ADVFN. Very good morning to you, young Clem.
Good morning, Nick.
Right, I've read lots this week, all right, whether it's Mr. Trump, whether it's NATO, whether it's Brexit, whether it's political, geopolitical. But the one thing that's stuck in the back of my mind, I looked at a chart at the S&P 500 on a close on Friday, and I thought, wow, I would be buying that chart. If I knew nothing about the fundamentals, okay, that chart looked really good to me, okay, and I can't believe I'm saying that here Monday morning. What on earth is going on in the planet at the moment?
Well, I mean, there's two explanations, and I think you have to kind of start digging for them, really. One of them is that we've been in a bull market for like 10 years, and nobody really kind of even thinks about a bear market. They're institutionally fixed on a bull market. That's it. So they don't think about a bear. Most of them haven't never seen a bear. So it's like Wile E. Coyote running off the cliff. And I think there's an element of that. But I do think that the Fed is on a path of supporting the market at current levels. So, you know, for bulls, it's going to feel like a bull market, but it's going to be punctuated with corrections. And, you know, I think we're in for a sideways trading market. The other thing is that they always say about the market that it climbs a wall of worry. It likes, you know, excitement, buy to the sound of guns, etc.
Yeah.
So you couldn't really get a more exciting time now, could you, with the presidential lunatic running around claiming that Europe is a foe, for example. I mean, you know, how random is that? So I think that the chaos that's entering the market is an excitement factor. And people, you know, tend to go long. I mean, maybe the answer is to buy, you know, military stocks. I don't know. But there's plenty enough energy in the world of politics to make people want to engage. And I think engagement drives the market higher. And I think we are getting a certain amount of that.
But do you think, okay, let's put it another way, in terms of the engagement, as you call it, okay, is that people at sort of the ninth innings, if this is indeed the ninth in terms of the cycle, okay, are just literally buying because they're scared of missing out, you know, and if we do get this sort of this final leg up, you know, a lot of money can be made or lost if you're not involved.
Well, you know, you can always make or lose a lot of money by not being in the market. I mean, I'll lose the opportunity because it's an opportunity cost. If the market crashes and you're short, you make a lot of money. If the market rallies and you're long, you make a lot of money. And, you know, upside down, if you're upside down, you lose a lot of money. I do think that being outside of the market is probably quite a good thing to be, as that's what I've been mainly for quite a long time now. I've been in and out. I'm still only half in the market. I've got a lot of dry powder because I do think there's a potential for a pretty significant bear market crash. But I do think the Fed and all the other central banks operate a plunge team by actually buying and selling bonds, and they use that to kind of try to have some sort of stability. Now, if you think about the bond market, if I was a person in bonds heavily, I would be getting out of bonds. I mean, you know, I do think there's a rising interest rate dynamic going on here. What everyone's starting to scream is, it's going to stop soon. It is honest. I think that we're in a bear market for bonds. Well, if you get out of bonds, where are you going to go? You've got to go into equities, haven't you? And you're probably going to go into interest, you know, dividend stocks. And if you look at dividend stocks, they've been very strong over the last 2 or 3 years. So I do think there's probably money rotating out of bonds into equities. The plunge team effect is at work because they are basically trying to smooth the market sideways by sometimes actually QEing and then reverse QEing and using that as a mechanism to smooth out the lumps. And I do think they've set the policy of going sideways. Well, if you have a safety net from the government in equities, it's a, you know, a Bernanke put, etc. You are really encouraging people to be in equities, aren't you? And you are therefore lowering the risk and therefore lowering the chances of people losing, and therefore they get out of bonds and they get into equities as a, inverted commas, safe haven. I mean, I don't think it's very safe at all. I think it's Wile E. Coyote running off the cliff to an extent. And I think we'll get a repeat of 2000 to 2004, which is a load of sharp corrections, a sideways movement, and an elevated opportunity to have a crash if something systemic comes up that's unexpected. So I think, you know, you sell the top like now and you buy the bottom like we might get in a couple of 3 months. So you just buy and sell that sideways trade, and be aware that if anything bad really does crop up, you want to, you know, run for the hills.
Well, the other statistic that caught my attention is that the FANGs in the US, okay, have got a bigger market cap now than the whole of the FTSE 100. All right, let's turn our attention to Bitcoin and the crypto world. Any movements last week? Anything of note? Anything caught your attention?
Well, I mean, I think everybody in the crypto space is praying for a rally, and I don't think they're going to get it. I think the best that can happen is it sticks around here. I think it can quite easily go to under 5,000s to 4,000s. And I think if there was to be a crash, and that's very, very possible with Bitcoin, you could see it down to the 2,000s. But, you know, these are lower levels. And if you were accumulating, I think you'd be accumulating slowly at this stage, just very slowly accumulating. I mean, I just put in a piece to Forbes last week. And if you look at Bitcoin in a log scale, it's perfectly, linear. So you're looking at these cryptocurrencies as being a logarithmic asset, not a normal linear asset. And the reason they're logarithmic is that they're penetrating the market. They're going from obscure to, top tier people, early adopters, and they're heading for the mainstream. And that sort of viral information flow, that growth into the mainstream market, is causing them to be assets that move logarithmically rather than linearly. And that means you can get absolutely killed, or you can make an absolute fortune. So, there's no necessity to use any leverage in Bitcoins to have huge returns or huge losses. So that's the name of that game.
Well, just to wrap up, I've read that Bitcoin was down 58% in the first 6 months this year, the worst performing asset class. Clem, we run out of time. We'll talk to you at the same time next week. That's Clem Chambers, the founder of ADVFN. Thank you.
See you soon, Nick.